And since income tax is the biggest expense that any individual or business owner has in their lifetime, there's this strategy or this deduction called depreciation that allows you literally to write off the entire value of your property over a long period of time. So a little bit every single year.
What's up, everyone? Welcome back to another episode of Syndicating Your Way to Wealth, the podcast that educates, inspires, and empowers you to build wealth through multifamily syndications. I'm Katie Cepeda.
And I am Yelfrey De Leon.
And today we have a very special guest. We have cost segregation expert, Yonah Weiss, who has helped his clients save tens of millions of dollars in taxes. And he has over 27,000 followers on LinkedIn, which I feel like it's very impressive.
Extremely impressive.
Yes.
You gotta teach me the tools how to do that.
Yes, he shares a lot of valuable tips on taxes, bonus depreciation, and cost segregation over there. So definitely check that out. Help me welcome Yonah Weiss to the episode.
Welcome.
Thank you. Thank you, guys. Thanks for the introduction. Yeah, happy to be here. To answer your question, Yelfrey, just one day at a time. That's it. You just put in the effort, put in the reps, like anything else in life. You become an expert overnight.
Right. You gotta stay consistent. I love that. Great. Well, thank you so much once again, Yonah, for being here with us today. I know that this episode will add tons of values to the investors out there and all the listeners who are tuning into this podcast. So thank you. That's great. Before we get started, why don't you tell us a little bit more about yourself and how you got started into the area of commercial real estate investing?
Sure. It's kind of a little bit of a long story, but I was a teacher for many years, about 15 years. And at a certain point, I think this was about 8 years ago or so, had a little turmoil and wanted to kind of change things up. The teaching was not paying the bills, essentially. And I realized, having a growing family needed some other source of income. And I asked a bunch of friends and acquaintances, what should I do? Right? I was open to opportunities, and real estate kept coming up in conversation with a lot of different people. And so I was like, okay, I don't really know much about it. Don't have experience in, finance or business, but I was open to it. And I started first with a good friend of mine who had been a commercial mortgage broker for many years. And he also owned some properties and was a property manager, managed them himself. And I worked with him. He just taught me the ropes of commercial real estate. Through that, I learned a tremendous amount. I think the biggest thing for a lot of people getting in the commercial real estate space is like the jargon and the language and so many acronyms and things like that. But once you learn that and get over that, it's such an incredible space. So many like-minded people. And I was just kind of overwhelmed. And then, a few years into it, I was doing various things, ended up getting my broker's license and, brokering residential real estate, and then doing some commercial deals as well. And I was introduced to this concept of cost segregation, and the company that I currently work for, Madison Specs, the biggest national company that does this. And I was really kind of blown away that when I brought this up to other people that I knew, nobody knew about it. Like, almost nobody. There was a couple people who were like very savvy, experienced investors who had, been doing it for 20, 30 years and were like, yes, of course, we use cost segregation. But almost everyone else exclusively had never even heard of it, let alone used it. And I'm sure that's probably what our listeners are thinking to themselves right now as well. What the heck is this cost segregation thing this guy's talking about it? But the first thing you need to know is just this incredible tax saving strategy. And that's, again, with my teaching background, I felt compelled to use that to kind of educate people, since almost no one knew what this was really about.
That's great. Thank you for sharing that story. It looks like, you kind of got into real estate first by talking to people, wanting to do a change in career. And yes, I definitely agree with you. All the jargon that we use in any industry actually is not only particularly to real estate. Me, myself, I came to real estate from the world of finance. And even though, because it's, I guess, at the corporate level, it's a little bit more, it shares more similarities between, finance, corporate real estate, et cetera. But there's always lots of things to learn, lots of jargons, and things in the industry. So thank you. Thanks for sharing that.
Yeah, and I'd like to know a little bit more about, if you could elaborate, how did you get involved specifically with helping investors understand the concept of cost segregation? Like, I know you said it was your background in teaching, but how did you grow to now having over 27,000 followers on LinkedIn? Now you give webinars. How did that start?
Yeah, it really started kind of naturally. I mean, I had the opportunity to work for this company, Madison Specs, and at that point, they were hiring someone in the business development side of, and I thought, I'll try to do whatever it takes, right? And I was first introduced, to a podcast. This was about 6 years ago. When someone asked me to be on a podcast, I was like, "What's a podcast?" I didn't even know what that was at the time. And to speak about cost seg, and I was like, okay, yeah, sure, I'll speak about it. And that really snowballed, because from there I went to another, and then in a very short period of time was posting, daily on LinkedIn. That was my go-to social media at the time. After that, after a year or two of doing that, I kind of expanded the horizons. And I really just kind of a sidebar, a side note, but I think when it comes to social media, it's so easy to just kind of do a little of everything, and it comes out being a lot of nothing, as opposed to focusing on one platform and really going all in and growing a following and understanding how that platform works, the algorithm, etc., and then expanding to it. So that's just kind of a sidebar. So that's what I do with LinkedIn. Grew a following by posting daily original content, and little by little, just doing hundreds of podcasts, webinars, et cetera, until I was, in a very short period of time, because of the experts that were on the team, that I'm extremely grateful to the company I work for, that have been, in the business for a couple decades, have the real experts. I mean, we're talking CPAs and engineers who have been doing this for, 20, 30 years. And I leverage their knowledge. I think it's a really important point for anyone starting out in any new industry. You can't do it on your own. You have to leverage and apprentice others who are the real experts. And if you have that kind of talent, I think one of the traits that I have is, as a teacher, the ability to learn something and give it over and educate in a very simplified way. So that's what I was able to do, because after I gave that first podcast, I was really curious to know, like, are there other podcasts out there that are talking about cost segregation? And I Googled it, and lo and behold, there were a couple other, I found a few other podcast guests, and I listened to them. I was like, this is so boring. This is so boring. It's like they were talking to accountants or people who were very knowledgeable about the subject in a very technical way. And I thought, that's not who the audience is. That's not who you want to talk about this in the most simplified way so that everyone can understand it at their level. And so that's kind of the switch that I had, and just, double down on that.
That's great. And, it's powerful what you mentioned there, because, you always have to know who your audience is, right? And you have to target your content and the educational piece to that audience. So, it's powerful to be able to identify that and be able to explain complex concepts to a kindergarten, basically. So that's great. And actually, going along with that same point, and before we get a little bit more technical with the questions, can you, in basic terms, explain what cost segregation is for our listeners, and basically what exactly it does, and how does it help investors with their investments?
Absolutely. So simply put, cost segregation is a tax deduction. Okay, it's depreciation. Depreciation is a deduction. It doesn't mean that your property is going down in value. It's a borrowed term. It's the name of a tax deduction that allows you, as a real estate investor, to literally write off as a tax deduction the income tax we're talking about, not property taxes. I know people get confused with that a lot. Even though it's real estate, we're not dealing with property tax, we're dealing with income tax. And since income tax is the biggest expense that any individual or business owner has in their lifetime, there's this strategy or this deduction called depreciation that allows you literally to write off the entire value of your property over a long period of time. So a little bit every single year. Cost segregation, in the simplest terms, is a way to accelerate those deductions and pull from this pool of potential deductions that you may never see and accelerate them to take a big portion of them in the early years of ownership. So it's a cash flow mechanism, essentially. Like you have this imaginary bank account with all these potential deductions, and instead of just taking a little deposit, withdrawal or whatever each year, you can take a big lump sum. It's like thinking about winning the lottery, right? Where you take the big lump sum or you take the equal amount like every year. And so with the time value of money, which means that a dollar today is worth more than a dollar, a year or 5 years from now, the ability for an investor to use their own money essentially and not pay income tax to be able to reinvest that and to grow their wealth at a much faster pace, that allows people to scale much faster.
For sure. Yeah, it's a cash flow machine, basically. And talking about that in terms of time frame or timeline, because I know, when you buy a home, you have X amount of time to depreciate the asset over its useful lifetime. How is it different when you do regular depreciation for an asset than when you do it using a cost segregation study?
Sure. So simply put, depreciation allows you to take a deduction for residential properties over a 27 and a half year period, and for commercial properties over a 39-year period, which means that if you buy like $1 million property, let's say, you always have to subtract a certain amount for land, which does not depreciate. And then the remaining amount, you can take, again, that equal deduction. So let's say $1 million property, you're going to be getting about $30,000 deduction every year for a multifamily property for that per $1 million. So it's multiplied. If it's a $10 million property, it's $300,000 deduction every single year. Now, your net operating income or your cash flow may exceed that, tremendously, right? If it's doing well. Property, it may be, a $10 million property, you maybe get, making, I don't know, $500,000 or $1 million of net operating income. So that deduction, while be it a great thing to have, is not going to cover or completely wipe out your tax bill. What cost segregation does is and it used to be called component depreciation, and let's just understand what cost segregation is we're depreciating the components of the property separately. So we're breaking down from an engineering perspective the property into different elements, different components, if you will. So you have the structure and the structural components like the roof, the walls, the foundation, the doors, windows. All that is really what the IRS says only depreciates on that longer 27.5-year schedule. But there are a lot of things inside that are non-structural that depreciate on a 5-year schedule. So think about like furniture or appliances, equipment, fixtures, cabinets, countertops, even flooring like vinyl flooring or carpeting, and many other things. All of that's on a 5-year schedule, which means you can sometimes have 20 or 30% of the total property value depreciating on this 5-year schedule. Now, again, it doesn't mean it's actually, being depreciated. It doesn't mean it's going down in value. It just means you now have the ability to do a cost segregation study and take 20 to 30% of the property value as a tax write-off in the first 5 years, as opposed to taking a little bit each year. And if you just think about the difference between a $30,000 deduction on $1 million property versus in the first year, maybe a $200,000 deduction by doing a cost seg or $300,000 deduction, that's, night and day in terms of what the ability you can do with those deductions to, reinvest that capital.
For sure. Thank you. And I guess just so I can rectify for the investors or listeners out there, why this is so important. In our business model, right? We're doing value-added acquisition where we are coming in and we are renovating units. We are putting, HVAC systems. We are remodeling, maybe adding some washer and dryers and other furniture, things like that. All of these items can be depreciated in a shorter time frame. And, this is where you get to keep more of that cash flow up front rather than having to wait for that 27.5-year schedule to depreciate the asset except the land. So thank you, Yonah.
When you do cost segregation, would you want to look at the property before you do the value adds, or would it be after?
Yeah, a really important question that gets overlooked a lot. So the first thing we do in a cost segregation study, and the best way to maximize the tax benefits, is to do that study of the property immediately upon acquisition once it's been placed in service. Now, I understand that's not always feasible and it's not always the business plan. Like, for example, if it's a single family and you're just doing like a complete gut remodel, and it's not even able to be inhabited at the time of acquisition. So you can't do the cost seg right on it beforehand. But the best case scenario is to do the cost seg, identify what all those elements are that you can write off, and then once you do the value add at a later point, any of the additional capital that's put into the property will be added on to your tax basis, will allow you to depreciate those new assets. And so you can really double dip. You can not only take the deductions of all the things, right, that were in the property as is when you bought the property, but then once it's been rented out and once you go ahead and replace those appliances, for example, now you can write off what you've essentially disposed of, and now the new property money spent on the capital improvements can be deducted as well. Just to clarify, if like in the example I gave, if you're just doing a complete remodel before renting it out, you're not able to do that. You're not able to get in both levels, because essentially what you're saying is, I'm not placing in service all the stuff I'm throwing out. So you can't depreciate something that's been placed in service.
Okay. So can you give an example where a cost segregation study significantly enhanced someone's tax position?
I mean, all the time, essentially, almost anyone and everyone who does a cost segregation study can benefit from it. Now, there's a really important thing and difference to make between what's called passive income versus active income. Now, real estate and passive deductions as well. Real estate is considered by the IRS passive income. Now, it may not seem passive to us, although if you are truly a limited partner, that's as passive essentially as you can get. That being said, the deductions of depreciation, which is considered passive, can only or is limited to offset passive income from rental properties, from real estate, which means if you have a W-2 or a high-paying job and you can only use the deductions from cost segregation or depreciation to offset any rental or passive income that you have. So you cannot, a lot of people think, oh, I'm a doctor, lawyer, whatever, IT, and I have a high-paying job. I want to invest in real estate so I don't have to pay taxes. Unfortunately, that's in many times not possible, not the case, because there is this limitation, what's called the passive loss limitations. You can check it out in IRS, the tax code. Passive loss limitations that say that you're not able to use that passive income or the passive deductions, of depreciation to offset active income. There are a few exceptions to that. And the most notable one, if you or your spouse are full-time real estate professionals, which means you actively are involved in managing or operating or acquiring or brokering real estate, then you can use depreciation to offset active income as well. There are a few other exceptions, but that's the most notable one.
I found this fascinating, to be able to understand the tax code and, really like dig deeper into, what each of them mean and how to use it for your benefit. So that's great. Thank you for providing all of those amazing tips, Yonah. So I know that we're talking a lot about cost segregation study, right? Can you walk us through the process of what that actually is? How do you conduct, a study of cost segregation to determine what assets or, what things can actually be depreciated or not?
The first thing we always like to do for anyone is run a free upfront feasibility analysis, so you can know ahead of time what the potential, first of all, what the cost is going to be to get something like this done, a full engineering study of the property, and then what the potential benefits are. And we mentioned earlier, kind of like round numbers, maybe 20 to 30% of the property purchase price can be accelerated depreciation. But what does that actually look like on a year-over-year basis? What does that look like on an after-tax basis? Because obviously people have different tax rates. And then that's something you can compare to what your normal, regular straight line 27.5-year depreciation would have looked like. And so that's something we always provide. That's the first step of the process. Gives a lot, just it's educational, and it allows you to have that conversation with your CPA and with whoever's doing your taxes to see, is this going to benefit me the right way? Can I use these deductions this year, for example, and how much? Then once you engage, there's a process of sending an engineer physically or at least virtually to the property. So with the help of technology and unfortunately, with the onset of COVID, we really had to position ourselves and transition into doing a lot of these studies virtually. You're doing thousands of these a year across the country, and we can no longer access properties. We had to come up with a solution. And what that was basically having a video call with someone on site when it was feasible. And nowadays, that's become pretty much commonplace, although we do still send our engineers to properties when it's a large project or something that needs extensive work that you can't just have someone on call for like 6 hours, right, walking you through a property, right? But most residential and multifamily properties, for example, is pretty straightforward, because the really interesting thing about a multifamily property is that the engineer does not need to go into every single unit to study it. He just needs to go into one of each unit type and layout, and then you can essentially copy and paste the findings from those unit types to the rest. So if you buy a 200 unit property and there's really 4 unit layouts, you need to go besides for the common areas and et cetera, you go into those 4 units, and then you can essentially take the pictures, measurements, et cetera, of those, and you can essentially apply that to the rest.
That makes sense. Always making sure that we don't go to the best looking properties within those types, right?
Yeah, pretty impressive.
Right.
What are some common challenges that investors can face when going through this cost segregation studies?
Believe it or not, I think the biggest challenge is having a CPA who understands this.
Wow.
And this is something, you would think, oh yeah, it's in the tax code. This is something that is recommended by the IRS to do, literally. But you have so many CPAs that don't even know about it or how to apply it. And so that's a challenge that I've seen over and over again. So make sure that if you are, investing in real estate extensively, have a CPA that understands real estate. So you may not be missing out something like this and many other things as well. That's the biggest challenge I see. The other challenge is really just understanding the timing, because like I said, it's not always going to be beneficial to get it done, right away. Or if there are renovations being done, at what point to do the costing, should it be done in 1 stage or 2 stages? And then more importantly, you don't have to get it done in the first year of ownership. You can actually get this done on a property that you've owned for several years. So it's a timing issue more than anything else. And so to figure out, okay, I may not have any taxable income this year because I have so many expenses or so much, I'm doing a big, project and there's so much deductions as is. But next year or 2 years down the line, I will have a big capital event. Maybe it's better to time the cost seg at that point so I can get the huge write-off or huge deduction at that point and offset the income then.
Makes sense. One question that I'm going to ask on behalf of my investors is, if I am a limited partner on, say property ABC that Helios acquired, and Helios did a cost segregation study on that property. So the property was qualified to, have cost segregation, right? As a limited partner, what benefits do I get, if any?
So as I mentioned before, there are limitations in terms of how you can use the cost seg to offset your, which sources of income. So if you are a limited partner who is not a real estate professional and your spouse is not a full-time real estate professional, you're going to, the benefits of the cost seg is that, unlike almost any other investment type, if the, full body of the partnership does a cost seg on the property, you essentially won't be paying taxes on any income coming in from that property during the life of ownership. So that's a huge thing. When you're talking about getting income, right, cash flow, and having it essentially be tax-free income during the life of ownership. The other thing is that even though you don't necessarily use all those deductions, because in our example where you're getting like this huge lump sum of deductions up front, and you can't use them against your active income, you don't lose those deductions. They carry forward, which means you're going to be able to use them next year or to offset any other investments that you have. So let's say you have, several rental properties or several investments, and you do cost seg on one, that can be used to offset the income from all of them. But not only that, when you sell a property, any of those extra losses that are carried over, that are still in that kind of imaginary bank account on your tax return, get released and can be used to offset the gain, the capital gain from the sale of that property. So not only do you not lose those deductions, you can actually use them to help you benefit not only through the cash flow through the whole period, but also on the back end when the sale happens.
Great, thank you. Yeah, this is definitely one question that many people would have. So thank you for answering that thoroughly.
For sure.
So, are there any specific scenarios where cost segregation may not be the ideal strategy for that investor?
Yeah, I mean, probably a couple really important scenarios to consider is number one, first of all, the first question I always ask is, like we said, are you a real estate professional? Is this something you can benefit from against active income? Number two is, how long are you planning on holding the property for? Because anytime you sell a property, you're going to be hit with not only a capital gain tax if you made a profit, but also something called depreciation recapture tax, which means you're going to be subject to paying a tax on the amount of depreciation taken. And so if you pay more depreciation by doing a cost seg, that means you just have a bigger tax that you're subject to on the sale. Now, if you're planning on holding a property for more than 2 years, then it's usually mitigated by the benefit of holding it, at least for 2 years, and the ability to reinvest that. The time value of money is usually greater than what you would pay on the tax on the back end. But if it's less than a 2-year hold period, I usually don't recommend getting the cost seg done, just because that the time value of money is much less.
What advice would you give investors who are considering incorporating cost segregation into multifamily syndication as a strategy?
Yeah, I mean, get in touch with someone like myself, educate yourself, educate your investors about the process. And as I mentioned, we provide a free upfront feasibility analysis, an estimate of sorts, where even when you're under contract on a property, you can already see what the potential tax benefits are going to be by doing a cost seg. And also understanding the bonus depreciation. We didn't really discuss that much, but that's something that will apply, to be able to kind of basically accelerate those accelerated deductions even further. And so understand that education is key. Yeah.
Definitely. And since you mentioned bonus depreciation, I know 2024, and now we're left at what, four years left for the bonus depreciation. If you can elaborate a little bit more on that tax benefit.
Yeah, absolutely. So a few years ago, there was a tax reform called the Tax Cuts and Jobs Act, and it introduced this new law called 100% bonus depreciation. What it says is, once you've done a cost segregation study and allocated certain components to a 5-year or 15-year or faster depreciation schedule, faster than that longer 27.5 or 39-year period. And again, we're talking about sometimes 20 or 30%, and sometimes more, depending on the property type, but 20 to 30% of the property into those faster 5 or 15-year schedules. 100% bonus depreciation said you can actually take 100% of those deductions in the first year, okay, upfront. So that's a big lump sum in the first year. Now, when it was written into law, it only applied between 2018 and the end of 2022. So if you bought a property between the years 2018 through the end of 2022, that property is eligible for this 100% bonus depreciation. In 2023, it went down to 80%, which means you bought a property, 80% of those deductions you can take up front, which is still huge. The remaining 20% can still be spread out over those faster 5 and 15-year periods. And it's phasing out by 20% each year. So this year, 2024, it's at 60%, et cetera, and it will keep phasing out unless, it's written back into law, which is quite possible that it make a comeback.
Great. Thanks for that tip as well. So you already know, 2024, for those investors listening, we're at 60%. Next year, we're going to be at 40% and then 20%. And, potentially it can phase out or it might come back, as Yonah mentioned. So stay tuned. Thank you for that.
Yes, Yonah, can you let our listeners know where they can connect with you and what's the best way to basically reach out to you?
Yeah, I mean, the best way is, we talked about LinkedIn, the followers. That's the best place. But I'm also active on other social media platforms. And if you do want to, follow me to see any of the content there, that's the easiest way. I do, however, recommend don't just hit that follow or that connect button. Take 10 seconds and write a little note. Tell me that you heard me on Syndicating Your Way to Wealth podcast. And I'd be extremely grateful to know, not just have a follower, but a real connection and real have that conversation.
I love that. That's one thing that I always tell people. Like, come on, it only takes 10 seconds to just write, like, hey, we connected through, I don't know, this event, or I listened to your podcast or whatever. Don't just hit that connect button, because then I don't know who you are. So thank you for reiterating that. That's great. Is there anything that you're currently working on? Any exciting news or anything that you want to tell our listeners before we go?
The Weiss Advice podcast is something, a really passionate project. I just love to interview amazing people in the real estate world and just give them a platform to kind of share their stories. That's something I've been working on for a while, and just really love it. Pleasure. Thank you guys for having me.
Thank you.